from a young age, I just always knew I wanted to be a business owner, bro.
Right.
Before I even knew what that meant, it just felt like, hey, I should be doing something independent. I should be creating something of my own, being my own boss, being in control.
Right.
Thanks for tuning in to the Black Millionaires podcast. I'm your host, Clift Roach II. This is CEO James Hill. Today we have a special guest for you guys. We have a CPA, certified public accountant, goes by Money Making Mitch. Welcome.
Thank y'all. I appreciate y'all having me, man. It's an honor. Absolutely.
Yeah, man. So being an accountant is very important in business because it's the language of finance, the language of business. And, you know, a lot of people just start companies or they just go to work and they don't really understand how taxes work. We obviously know we're not getting taught it in school. So could you just give us a background of how you start to learn and find a love for, you know, accounting, the profession in itself? Because especially a lot of people in our community, they kind of run away from that financial, you know, finance talk. So how did you get into being a CPA?
Yeah, so with me, as they mentioned, I go by Money Making Mitch. My full name is Michel Valbrun. I'm a certified public accountant and tax strategist and award-winning author. And really how I got into accounting and just the whole tax world and really now focusing more on tax planning and tax strategies is my parents are from Haiti and they came to the United States really with a goal in mind, and that's to help us out and really create an opportunity for us and our family, and actually created and started this tax business. So they were doing tax returns for folks. So that kind of piqued my interest when I was younger. I didn't know for sure that I wanted to 100% go the tax route, but I knew I wanted to get into entrepreneurship. And then, you know, as I started going through and really getting into entrepreneurship, I did hear that accounting is really the language of business. And I was like, yo, if I'm going to do business, I really want to understand this accounting thing. I noticed that a lot of people struggled with it. Kind of naturally, for me growing up, I was kind of just good with numbers. So that kind of came naturally to me. So yeah, I went to the University of Florida, actually, which is like one of the top accounting schools. And then I don't think I shared this publicly, but an interesting thing happened. So when I was going and I was doing this, I was volunteering for this program called VITA. Mm-hmm. And basically what they do is they do free tax returns for folks. So basically you go in there, if you're a lower income individual, you could do your taxes for free. And, you know, as I was going through a couple's taxes, you know, they had some questions, like they ended up owing some money on taxes, which is normal. But then they asked me, they were just like, well, how do we save money proactively in the future? And I froze. Like I didn't know the answer. And even though, like, you know, you go to school and you expect to know this information, but the schools and the accounting programs are not really designed to help you and teach you and educate you on small business taxes and how to help people proactively save. It's really just more from like a corporate perspective, more of an individual, more theoretical and many things. So then I really dived into and really got a love and an interest for helping entrepreneurs and people proactively save money on taxes.
Okay, so when you talk about individuals filing the taxes, they have options. They can come see a professional like yourself, or they can go on one of these websites and try to wing it. It seems like this day and age, a lot of people lean towards, I want to do everything on my own, right? Especially business owners. So talk about the advantages of actually working with a professional like yourself versus just trying to do everything online on your own.
Absolutely. So really when it comes to taxes, the tax code is extremely complex. If you were to break down the tax code and like print out all the pages of the tax code, is over 70,000 pages. So like to break that down and understand everything, you're not going to do it. The great thing with some of the softwares that you can use, like the TurboTax, etc., it does help if you don't have a business, if you're just an individual. A lot of the tax codes and a lot of tax strategies don't really apply to you. There are a couple of things that you could do, but a lot of the tax code is written for entrepreneurs, business owners, real estate investors, stock investors, because in the government's eyes, that is a way to stimulate the economy. That's a way to circulate, provide employment, provide housing, to provide people to invest into businesses. Mm-hmm. So I would recommend, if you have a business, if you're making over, I would say 80,000 to maybe between 80,000 to 100,000, I highly recommend you working with a professional, because there's different things that you could do with your money from a tax perspective to help you save a lot of money. I mean, you could see, not to get too much into politics, but Trump paid $750 on taxes, and this guy, you know, on paper allegedly he's making billions of dollars, but only he's paying $750. So there's ways to maneuver the tax code.
You answered my question. I was gonna say, when should an entrepreneur hire a CPA? So you said 80,000 to the $100,000 mark. Is that in profit or is that in revenue? So are we talking? You did $80,000 in sales and revenue, so you need to really get a professional involved at that point.
So when I said the 80,000 to 100, that's for an individual. So if you don't have a
okay.
business at all,
Okay,
so
sorry about that.
if you're making less than 80,000, whatever, you could probably just go on TurboTax, knock it out, because there's only a few things that you could do to really maneuver the tax code. If you're a business owner, I recommend hiring a CPA yesterday. You know what I mean? Because what from my experience, the majority of entrepreneurs, they end up overpaying in taxes. And when I say overpaying taxes, it's that they're paying more money than they need to in taxes because they're not taking advantage of all the different tax strategies and things that are out there. So what's going to happen is, if you're not working and not getting that proactive information, that upfront information to help you maneuver and move your money in certain ways, so when it comes tax time, to help you save, then it's going to be too late for you. So that's why I say, like, yesterday, if you have a business, because the tax code opens like wide up for business owners.
So give us a specific example of a mistake that business owners make that cost them a lot of money in taxes, right? So what is one thing that sticks out that you see that happens quite often where they end up paying more than they should?
Yeah, I got a couple of examples. So to really, first and foremost, so if you have a business, and according to the IRS, there's different requirements to do that. To be basically, in the IRS's eyes, if you are in the pursuit of income, if you are in pursuit of profit, then you technically have a business. What a lot of people do, especially when they're starting out, they have their business, they're not making any money in the first year, and they're just like, well, my business didn't make any money, I'm not going to report it.
Right.
And it's crazy, because what happens is, yeah, your business didn't make any money. Let's say you made $100, but you probably spent $3,000 on that business. So that $3,000 then becomes a write-off for you, a loss that you could then take against your let's say you're working
tax liability.
Yeah, your tax liability. Or let's say you're working like a full-time job, you have a side hustle. Your side hustle doesn't make any money. You could then take that loss and apply it against that full-time job that you're working, and reduce your tax liability that way.
Right. So people are basically missing out just for a lack of knowledge, right? So they just don't know this information, and it's costing them. I mean, is it costing them the 3,000, or would you say it's costing them that money if they're not filing it?
Yeah, so it leads them to overpay. So basically, the way to look at it, just hypothetically, theoretically. So let's say you have the $3,000, right? The $3,000 is a deduction for the business. So for business owners, they have this formula called tax-free. So if you break down, it's an acronym that I came up with. So free, it stands for, so for a business expense, the F stands for business. So the expense needs to be for business. So if you have anything that you spend for business, whether that's meals, traveling, supplies for the business, office equipment, those things you could write off. Hiring professionals like a CPA, etc., you could write those things off. The second part of that is it needs to be considered what the IRS considers regular for the business, so it needs to be ordinary, so it needs to make sense for your business. So sometimes what people try to do is they're doing multiple things, and they're trying to write everything off from that one business, but it needs to make sense for your business. So let's say that you are a web designer, right? For your business, it makes sense for you to expense a computer. It makes sense for you to expense things like a mouse or headphones or whatever the case is. So you want to make sure it makes sense for the business. The next part of that is also needs to be essential for the business. And the last part of that is it can't be extravagant. So you can't go out and, let's say for a meal, like I said, you can deduct for meals, but you can't. The IRS is going to question you if you go out for a meal, like a one-on-one meal, and you spend like $10,000. They're probably gonna raise their eyebrow. They're gonna want to ask questions because it's extravagant. It doesn't make sense for the business. So that's one of the things that you need to do. So going back to that question with the 3,000. So if you let's say you make $100 in your business, you have a $3,000 deduction. The pretty much the net benefit, and this is just an estimate. So let's say, just to keep the numbers simple, I'm going to keep it around round numbers. Let's say you're at a 30% marginal tax bracket. So 30% times the 3,000, that is 900. So that's like a $900 savings that you had
Okay.
in dollars, because it reduces your tax, because basically you're taxed on what they consider taxable income. So that $3,000 then would have reduced your taxable income by about the 3,000, and you multiply that by the tax rate, and that's how you save the money.
Oh, so right. So you're not missing out on the 30, but you're definitely missing out on the 900.
Right.
Okay. Okay, that makes sense. All right, let's talk about like tax planning, right? So you say entrepreneurs should hire somebody yesterday. So if you're an entrepreneur, and a lot of small businesses, they try to write off a lot of expenses just so they can avoid paying taxes, right? But then when you're trying to get financing and things of that nature, you kind of run into problems. So like, talk about like tax planning for 3 to 5 years out. How does that work for somebody who's making, let's say they're making 50,000 at the moment, and they project to make like 200, 300 based on their projections and the contracts and everything that they sign. How does the tax planning work? Would you have to reevaluate once you start, making a lot more money, or can you follow the same plan?
For the most part, you can follow the same plan, because a lot of the things are going to apply, but you do want to revisit it once a year. So I would recommend, because especially if you're projecting to grow the business, you're projecting to do more in income, because then that opens up more opportunities for you to be able to move around your money and funnel your money around. So in the case of, let's say, and then that was a very good question that you asked about someone who wants to own a home versus trying to reduce their tax liability. It's really a balancing act, right? So that's something that you want to communicate up front with the CPA and let them know, like, hey, I'm looking to get a home. How can we plan to, one, let us pay the least amount of money as possible on taxes, so then I will still be able to qualify for this loan and get the home, but then also, kind of just having that balancing act. But if maybe you're not looking to get a loan or looking to purchase a home, then it may be more advantageous for you to record more expenses and be more, a little bit more aggressive with that.
So one thing that I feel like is really popular for young entrepreneurs is the thought process is, let me get an LLC because it legitimizes me, right? It's just like, it don't matter what my business is, but I thought LLC after it, it's good to go, right?
Yeah.
So what tax pros and cons come with having LLC attached to your business?
Yeah, that's a great question. So the interesting thing is, and a lot of people, even tax professionals, don't really understand this concept, but there's a difference between a legal entity and a tax entity. So with the LLC is actually what's considered a legal entity. So an LLC is just a limited liability company. All that does is it really just protects you and your personal assets. So it separates you and your business. So let's say someone were to come after you, someone would try to come sue you, they can't come after your personal assets as long as you have that LLC structure in place and you're doing the things that are required in order to maintain that separation. One of the requirements, and this is something that people don't talk about enough either, is that there's a concept called piercing the corporate veil. So what happens is people think they have their LLC and that's it, I'm good. But there's things that you need to do to continue to maintain that separation. So once you, let's say you set up an LLC, you want to make sure you have a separate business bank account. You want to make sure that you're separating your personal expenses from your business expenses. Like, you can't commingle, because then they're not, because in the government's eyes or in the court's eyes, there's no separation between you and the business.
Right.
So, like I said, so with the LLC, there's no tax benefit with having an LLC. The LLC is good. It's good business practice to set it up, but there's no tax benefit. Really, the tax benefits come from the tax entities, which is going to be your sole proprietorship, your partnership, you have the S Corp, you have the C Corp. Those impact you from a tax perspective.
Okay. Talk about the different tax professionals. So a lot of people follow me on Instagram. So people DM me and say, hey, I'm a tax attorney, hey, I'm a CPA. Right. So what's the difference between that compared to somebody who's just working at Jackson Hewitt, doing taxes for people in the grocery store? Like, what's the difference?
Yeah, there's actually a big difference. So there's a huge difference. So not all tax professionals are the same, and I'll break it down. So I have this hierarchy. There's levels to this, right? So there's levels, like Meek says. So you got, on the bottom level, you have what's called a tax preparer or a self-preparer. So that's either you doing your taxes on TurboTax or whatever the case is, or someone at like an H&R Block or Jackson Hewitt doing your taxes, the interesting thing with that is the requirements to work or be able to prepare, basically to be able to prepare taxes for someone. If you wanted to go out and say, open the door and say, hey, I'm a tax preparer, you have the authority. You can do that, right? There's the requirements are pretty low. If you go on the H&R Block website, I think they don't even necessarily require you to have a GED to do someone's taxes. They have a training program that they make you go through, whatever, so you can understand the basics, but it's really just taking someone's information, putting it into a software. Then you have a higher level up of that. So you have tax attorneys and you have enrolled agents. So tax attorney, they pretty much specialize in tax law, so they're familiar with tax laws, they understand the tax code very well from a legal perspective. You have enrolled agents, that's a higher level up. These folks have gone through a rigorous program with the IRS. It's pretty much a stamp of approval from the IRS to do someone's taxes, and they're a little bit more educated on taxes. And then, in my opinion, above that is where you have the CPA. So the CPA is a certified public accountant, and basically with the CPA is required to do a ton of things. So one, the CPA needs to have, depending on the state, you need to have close to 150 credit hours. So that means like an undergraduate degree and a master's degree essentially. Then you have to pass a 4-part exam that goes over accounting, taxes, business law, ethics, etc. And then on top of that, you have to do continuing education credits as well. So pretty much every year we're required to do a certain amount of education credits to maintain that. So really, the CPA is probably one of the top, but then I think there's an even higher level, right, on top of that, and I call that the tax elite. So what the tax elite is as I mentioned, as a CPA, as someone who went to a really good accounting school, they don't necessarily teach you what you need to do to save money as a business owner, as a business professional. So you have to do a lot of self-education, a lot of self-learning. So what you're going to find is that just because someone's a CPA doesn't mean that they understand the tax code. They just understand enough, and they probably could maybe potentially learn how to research and get the information that they need, but they have a pretty good foundation of accounting and taxes, but they don't necessarily understand business tax strategies. So with the tax elite, that's another acronym. So the E stands for experience. So you want to understand, okay, how much experience does someone have? So you definitely you don't want to work with someone who's been doing taxes for a year. 5 years, maybe honestly 10 years is really what you want to be looking at to work with a professional, because during that 10-year period, they've seen changes in the tax code. They've been doing it for a while, and they probably have a good knowledge and understanding of the different, for the most part, most of the situations that can come by. So that's number one. The L is for legal representation. So this is going to be important too. So with legal representation, a CPA, a tax attorney, an enrolled agent, those individuals, they can actually represent you in court. So let's say that you have issues with the IRS, they can go and represent you and speak on your behalf and kind of, have your back in those instances.
Right.
So that's another thing. The I stands for intangibles. So you basically want to look at intangibles. So what kind of, how many clients have they worked with? What kind of industries have they been involved with? So you really basically just want to look for social proof. It's like, who have you worked with? Have you seen this scenario before? What's your experience with XYZ? The T is for training. So you want to make sure, again, as a CPA, one of the things that are required is that you have to do continuous training in order to maintain your CPA license. And then last but not least is going to be education. So you just want to make sure that you work with someone who actually went to school for taxes, in my opinion. Again, like what you're going to see is, especially this upcoming tax season, I've seen a lot of kind of pop-up tax businesses and tax in the box and stuff like that, which is and I'm not hating on it. It's cool. I want people to go out there, get money, help people out or whatever. But if you're working with someone who didn't necessarily go to school and they're just trying to get some quick money during tax season, you know what I mean? How invested are they going to be? Because you guys are both professionals, business owners. Business doesn't stop April 15th. Right. You know what I mean? Like business is for the whole year, so you want to make sure that you're working with someone who's going to be available for you for the whole year.
I know we've been talking a lot about what business owners can do in terms of taxes. Talk about if there are any little steps that people who are just W-2 employees can take to save on taxes, if there are any advantages for them, because I know, like you mentioned, tax code is designed in favor of business owners, right?
Right.
So are there any little small tricks or trades that your average 9-to-5 workers can take advantage of?
Yeah, absolutely. So with the 9-to-5 workers, so really there's a couple of ways to save big, and this applies to business owners and 9-to-5 owners. So the ways that you can save money on taxes is maximizing deductions. So that's one thing. So you want to make sure you're recording your deductions. So one of the deductions that's available to business owners and individuals is the standard deduction and the itemized deduction. So the standard deduction is pretty much a deduction that you get right off the bat, that for taxes. So whatever, let's say you bring in, again, $50,000, you automatically get, if you're a single individual, I believe you could save 12,000, around 12,000. Married filing jointly, 24,000, right? That number doubles, right? So that's number one, the standard deduction, or you could take an itemized deduction. So the itemized deduction is going to be a list of different items. It's going to be harder to meet that threshold because when Trump got into office, he pretty much doubled the standard deduction. So most people are going to do standard deductions, but you still have the itemized deduction where you could take things like mortgage interest, medical expenses, etc. And then if that comes out to more than your standard deduction, then that can help you out some. So another way that you can do, which is probably going to make change with Biden's tax plan, is retirement. So if you're a W-2 worker, investing in that 401k is going to help you out a lot because your 401k contributions reduces your taxable income. So that's a deduction that you could take. So with the 401k, you can contribute up to, I believe, $18,500 or $19,500 depending on your age, and that can reduce your taxable income too as a W-2 worker. And I'm trying to think about what else are going to be the really good ones for W-2 worker. Those are pretty much the biggest things that are going to help you out.
Okay, you mentioned when you was talking about just being a tax elite, right? You mentioned their social proof. So who have they worked with? My question is, do you need a different CPA for, like, say you're a person and you're very diversified. You have a stock portfolio, you have real estate investing, and you have your business. Would you need multiple CPAs, or would you just want to get somebody with experience in all of those? Because you can have experience in, small business taxes and not really real estate taxes, right?
Yeah, that's a good question. So I would recommend that's part of what the questions that you need to ask as you're interviewing that tax professional is understanding, okay, do you have experience? I get that you know how to do business, but do you have experience with real estate? Because there's different laws and niche specific strategies for real estate. Do you have experience with the stock market, stock options, Forex, etc.? And so, yeah, you definitely want to make sure that they have that covered. One of the things I think is important to also include with that tax elite too is making sure that that person's connected to other professionals too, that they could reference out work. So let's say that they may not know the answer, but they have people in their network that they can reach out to or reference and kind of do a referral to help you out in that case.
And you mentioned investments and what the taxes look like on that. So people understand that, they have to pay taxes on their paycheck, but when it comes to capital gains taxes and investments, sometimes people don't even realize that you have to pay taxes when they jump into investments, or they know it, but they just don't think about it, right? They don't think about how to protect themselves from that. So explain to people what capital gains taxes are and what options you have to avoid them, if any.
Yeah, so capital gains tax, the way it works is pretty much you invest in what's called a capital asset. So let's say that could be stock, that could be a property, and if that property or stock increases in value, appreciates, then you have to pay taxes on that difference. And as it relates to capital gains tax, you have short-term gains and you have long-term gains. So if it's short-term, if you're holding it for less than 12 months, then you pretty much get hit with the ordinary tax rate. So whatever your marginal tax bracket is, that's what you get hit with. With the capital gains tax, depending on the level it is, you have different tax percentages that you get hit with. So you could do it's either 20 and 25%, and at certain levels it also change as well. So that's one of the benefits. So one of the ways and one of the strategies that you can use as an investor is there's a strategy called tax loss harvesting. So with that, basically, let's say you have a portfolio. Let's say you buy some Apple stock back in the day, and you think you pretty much feel comfortable with where Apple's at. You think they're pretty much peaked. You want to go ahead and let that go. One of the things that you have to pay capital gains tax on that. But one of the things that you could do is you could find another stock that's not performing well. So maybe let's say something like in the cruise industry or whatever, right? You go ahead and sell that in the same year. That loss can offset that gain and reduce your taxable income.
Wow, I mean, I think people don't understand, like, so when you sell, I think it's hard because when you get paid, you have to pay taxes. Like, I feel like if we had to pay taxes, like you get our paycheck, then we got to go up the street and pay taxes. It'd be a lot harder to get people to pay taxes, right?
Yep.
But with capital gains, you're not paying it the minute you sell the asset, right? You pay it at the end of the year.
It kind of works the same way like let's say you own a business. So yeah, that's how it used to be with taxes. Is they used to give people you pretty much had to go in and pay taxes on your own. They found that wasn't working. Right, they're like, we can't trust y'all. We need to take this out automatically. So that's what they do. But they do give business owners and investors the flexibility to do it. You could make estimated payments, and that's actually required because sometimes if you make too much and you end up not paying during the year, the IRS is going to come back. It's like, listen, you've been holding on all this money. You're supposed to pay us out during the year, and then you can get hit with some fines and penalties for that too. So yeah, you want to, again, it's going back to that working with the professional, planning and really strategizing on, okay, do I actually have to make the estimated payment? What's my gain looking like? How long I've been holding on to it? What's going to be the difference in that? So just planning up front.
You mentioned Joe Biden tax plan, right? A lot of people got scared. We had celebrities like 50 Cent posting it up,
right,
talking about, the 62% in California and I believe 58% in New York. Could you just kind of explain that and break that down? Because I'm a media guy, so I saw a headline. Most people, they don't read the article, right? They're not going to go read his actual proposal. They're just going to see 62% tax rate and think it's going to affect them as an individual. So can you kind of break that down for us?
Yeah, so that's the interesting thing with it. So going back to the media, I think it's just a really good way to get people's attention. They see that 62% up there for California, you start freaking out. You think if I make $100,000, I'm about to get hit with $62,000 in taxes, and it doesn't work like that. So yes, with Biden, one of the things that he's looking to do is try to get more money and try to increase taxes for individuals who are making over $400,000. So that's number one. So if you're making over $400,000, you should have a little bit concerned, but not too much. With the 62% in California and the 58%, I believe, in New York City, one of the things basically what that number comes out to is you have the federal tax rate and you have the state tax rate. So they're just combining it, trying to blow up the number, trying to make it bigger than what it actually looks like. He does want to increase the marginal tax rate. So basically when it comes to taxes, you don't get hit with the full percentage, like that full 62. It's progressive, right? So we have different tax brackets. So you have the 10%, 12%, 24%, 32, 35, 37. And each of those levels of income, they get hit with their own tax rate. So what ends up happening is your effective tax rate, which is pretty much the tax that you pay divided by your taxable income. What you actually end up paying, it's not anything close to that number.
Right.
So that's number one. But he does want to increase it. So he wants to increase the highest tax bracket, that 37%. He wants to increase that to now, I believe it's 39.7, something like that.
Right.
So he does want to increase that. He does want to increase the corporate tax rate. Right now it's a flat 21%. He wants to increase that to, I believe, 28%. And the interesting thing about it is a lot of this stuff was already in place pre-Trump.
Right.
Trump came in, he did one of the biggest tax reform in the last 30 years. So he's pretty much wants to bring it a little bit back to how it was before. And his goal is to increase the revenue from taxes to, I believe, between 2 and 4 trillion over the next 10 years, because we're we're at a deficit. If you can imagine all the money we've been giving out for COVID
Stimulus,
and all the stimulus, and like, we got to pay that back. So his plan is to go ahead and get some of that money back. And also too, you have to understand, this is just what he's proposing, right?
Right, it has
so
to get passed,
yeah, it has
right.
to get passed through Congress, through Senate, and we have to see how that plays out, right? Are there going to be more Republicans, Democrats? So let's say it does pass Senate. I don't think, from what I understand, it's not something that he plans on implementing like the first year, maybe the second year, but really, again, if you're not making over $400,000, you don't need to be worried. If you are making over $400,000, again, it's just having that, working with that professional upfront to let you know what's available for you tax-wise. And as you can see, like there's individuals like Trump who pay $750 in taxes. There's ways to maneuver and to use the tax code to your advantage. And there was a study done actually by the Tax Foundation. They're supposed to be nonpartisan, so they're not supposed to be biased. And they're saying that the impact of the increase from Biden's plan, they did an analysis. Really, the impact is going to be 17%. What they're thinking is going to 17% increase for those making over $400,000. For those making under $400,000, it's going to be like less than 1%. So if it really comes down to 17%, you know what I mean, they can they can handle it.
So when this stimulus check first rolled out, right, in the middle of COVID, some people were, jumping for joy about it. They just think, hey, it's a free $1,200. Some people were running around saying, no, I'm going to have to pay this back in taxes next year. There's a lot of confusion about that. So can you just break down not only what that $1,200 in the stimulus check does actually look like from a tax point, and in the long term, do you think that will contribute to a rise in taxes overall to make up for the deficit that it costs the government to write those checks?
Right, absolutely. So it's not free money, all right? So it's pretty much a loan, something to stimulate the economy. The most important thing for the government is to stimulate the economy, increase consumer confidence so they could spend their money. That money is the idea is the money that stimulus money knows not supposed to be taxed, but sometimes what they do on the back end, and that's how they kind of make all this work, is they may change some of the tax codes and maneuver things in probably maybe not next year, but they're gonna get their money back somewhere.
Yeah,
you know what I mean? So they're gonna figure out some way to get their money back from that perspective, and that's probably what Biden's thinking. Is just like, okay, we need to get some of this money back. How are we going to do it? And a lot of those things that he's doing to increase, the corporate tax rate and do some other things where he's getting rid of some of the things that Trump put in place with his Tax Cuts and Jobs Act, is really to put in place new programs. So he wants to bring back the first-time homeowners buyer's credit. So he wants to give you guys $15,000 if you're a first-time home buyer. He wants to increase the child tax credit. So with the earned income tax child credit, you have to have children. So what he wants to do is he wants to extend that out to people who are 65 and older, to be able to get some of that money as well, even if I believe even if they don't have children. He wants to also give you some tax credits for investing in like renewable energy, and they have this big green initiative. So there's things that they're doing to balance it out. But I think from his perspective, and I think he probably paid well over six figures in taxes. So he's not on the extreme side where he's paying like nothing in taxes. But I think he just is trying to get it to something that's a little bit more reasonable, more fair.
Now, I saw a headline, and it's kind of not getting political or whatever, but Joe Biden's campaigning basically saying he's going to raise the taxes on the wealthy. We kind of knew that. And he's going to lower taxes on people, on working class people, middle class. That's the term they like to throw around. So the foundation that you just quoted said that it should affect the middle class people and raise their taxes by 1%. So where's the disconnect coming from? Are the taxes going to be lowered, or are just, 1% is kind of staying the same, really, but it's just like,
Yeah. So he's pretty much he's going to increase it on individuals making more than 400,000. So he's doing things, not to get too complicated, too deep into it. So he's getting rid of things that a lot of people who are wealthy benefit from. So like inheritance. So one of the things that they do is let's say your mother passes away, and she gives you the house. You would, with Trump's tax code. Well, then this is gonna get a little bit complicated. But I'll break it down. Okay, so basically, let's say your mother buys a home for $100,000. She passes, and the home is now worth $300,000.
Right.
So one of the things that Trump has is the pretty much the cost and the number that they use to calculate the basis or the cost of the home is based on the date of the death.
Right.
So Biden is looking to eliminate that and saying instead of having it at the date of death, he wants to bring it back to the original. So that difference you get taxed on. So, and sometimes, a lot of times with wealthy families, they pass it down. Okay. Yeah, a lot of times wealthy families pass down these assets, and they're able to not have to pay taxes on it.
Right. So if I buy, like you said, if I buy a house for $100,000, you pass away 20 years later. That's, inflation and your appreciation. That's 20 years of appreciation.
Right.
So if the house doubles or triples, they want me to pay taxes on what I'm not saying they. Biden plan will allow you to pay taxes on the death, and Trump plan tells you to pay taxes on when you first bought it. So that original 100,000. Am I?
Yeah. So basically, it's a complicated example, and there's also an exemption too, right? I forget the exemption amount, but you won't necessarily have to pay taxes on the 100% difference. I think they do allow a certain amount to not have to be taxed on. But the idea is yes. So Biden's looking to have you use like the original cost of the home instead of using the cost at the time of death to be able to get taxed on. So but again, like I said, he's implementing. He's really looking at what the wealthy are doing. Another thing that he wants to do is change the way we talked about retirement, right? So one of the things with retirement is he wants to, instead of doing like a deduction for retirement, he wants to give a tax credit for retirement. So basically what he wants to do, a 26% tax credit. So basically the way it works is going back to someone who's making, let's say someone who is in the like, let's just say 30% tax bracket, just to keep the number simple. So basically let's say you put money into a retirement account. Let's say you put 10% of your income into a retirement account. That's $10,000. You're at the 30% tax bracket. The estimated savings is going to be like $3,000. Right. And let's say you're at the $50,000 mark. The same person that you do 10% of their income, that's $10,000, and then let's say their tax rate is like 20%.
Right.
So it's only $2,000 of savings for them. So he kind of wants to make it equal by saying everyone's going to get 26% of a tax credit based on the amount that they contribute to their retirement account. So if you're in a tax bracket that's higher than that 26%, then you're going to lose some of the benefits. Some of the savings from for doing like pre-tax contributions to a retirement account.
So to take a step back off the retirement conversation real quick, back to the transfer of assets, right? So generational wealth is what everybody wants to talk about. They're throwing the terms around. No one ever says tax efficient generational wealth, right? Yeah, it's one thing to transfer money, assets, cash, businesses, properties, etc. But it's another thing to do it where you aren't putting a tax burden on the next generation. What's the single most efficient way for someone to transfer wealth to the next generation without a tax bill?
Yeah, that's really going to get into estate planning. So estate planning is pretty much coming up with a plan of how wealth and assets are going to be transferred. So there are different ways, and it gets more into a legal aspect of things. But basically what you can do is you can set up a trust in such a way to where you pretty much navigate it to where you can reduce that tax liability, but it gets pretty complex on how to do that.
Absolutely.
Yeah, I mean, I appreciate you sharing all this information with us. I think one thing people don't understand is, like, people think when they're like, you making like $40,000 or $50,000, you're paying more in taxes. Like, you're paying a lot in taxes. So people see like, oh, the 30% tax rate, but when you really do the numbers, a lot of people, especially if you're working at a job, they're not really paying 30% of their check in taxes. So can you break down an example of that? Because if I'm a guy making $50,000, I didn't. So 30% of $50,000, I didn't pay that in taxes, right?
Right.
So that would be like $15,000. I didn't really pay that.
Yeah, exactly. So, yeah, as far as, well, yes and no. So it's not coming directly out of your, what? Let me start off with the no. So no, you're not paying that. It's not a flat 30%. So again, with the American tax system, it's progressive. So each dollar, there's different brackets. So you have the 10%, 12%. So it's going to be hit at those different tax rates.
So progressive meaning once I make $10,000, I grow and graduate into the next tax bracket. Once I make $25,000, I graduate. Once I make 30, 50.
Well, yes and no. So let's say, and I forget the different thresholds of income, but let's say we start off with the 10%, right?
Right.
So let's say for the first 10, going back to that 50,000. So the first 10,000 of that 50 is going to get hit with 10%.
Okay.
Then the next maybe 5,000 of that is going to get hit. $5,000 now is going to get hit with the 15,
Right.
or sorry, with the 12, and then the next portion of that is going to get hit with the next gradual increase in that. So that's part of it. So then when you break it down, pretty much the average of that, or the effective tax rate, is going to be lower than the highest tax marginal bracket that you're at.
Right. Okay. Yeah. I mean, because I know a lot of people get confused in that. So once you go over, okay, say you get a raise at your job, or you have some type of income from a business or whatever. Let's say you make $30,000 from your side business. So now that $30,000 goes on top of that 50. So now that $30,000 that you made, that may be taxed at a 30% tax rate, or whatever the tax rate is for that amount of income.
Yeah. So as far as businesses, so you have, going back to the tax entity and the legal entity. So you have what's called a pass-through entity. And basically with the pass-through entity, that income or the profit from the business gets passed on to your personal tax return.
Right.
So one of the tax strategies that you could use is, let's say you have like an LLC, which is that legal entity, but you're taxed as a sole proprietorship. So with that sole proprietorship, you automatically get hit with 15.3% in taxes. Because basically what the government's trying to do is they're trying to get Medicare and Social Security just like you would do from a W-2 job. And basically you usually just pay that, you and your employer split that 15.3. As a full-time as an entrepreneur, you're the employer and the employee, so they want to get that tax from you, so you do get hit with the 15.3 on the profit of the business. So one of the things that people do is they switch over to an S corp, because the S corp allows you to avoid some of that 15.3%. So instead of, let's say you have a profit of 100,000, so instead of getting taxed fully on that 15.3 on the 100,000, maybe you give yourself a salary of 50,000 and only get hit with that 15.3 on the 15,000.
Okay, that's the next thing I was gonna ask. So if I'm someone and I made $100,000 a year in profit on my business, should I just take that and just pay myself a salary to avoid paying the pass-through taxes? So you get what I'm asking?
Yeah. So so it depends on your tax entity and your legal entity. So let's say you expect to, before the year's over, you want to do this proactively. So before the year's over, let's say you expect to make $100,000 in profit with the business. Usually, I think the threshold, I say the threshold to switch over from a sole proprietorship to an S corp is if you think you're going to make $50,000 in profit. So basically, the strategy there is that you want to put yourself on payroll, give yourself what's called a reasonable compensation, and there's diagrams and charts on what that looks like for you. But you want to pay yourself what's called a reasonable compensation. Then you pay the 15.3 on the salary, and then that profit from the business doesn't get hit with the automatic 15.3, but it does get brought over to your personal return, and then wherever you fall from a tax bracket perspective, that's how you get taxed on it. But it does save you money. That could save you that move right there can save you at least $7,000 in taxes.
You've been dropping gems on us, man. I feel like you've just been going. I want to digress just a little bit and pivot. So back to the beginning of the conversation, you mentioned that your parents started a tax business, right? So obviously you had some early on exposure to it. Was that always the route you wanted to go with your profession, or did you have desires to do something totally different and you just kind of fell into their footsteps?
Yeah, it's interesting. Honestly, I kind of just fell into their footsteps. So I knew I wanted to be an entrepreneur, get into business. I did like the idea of coaching people, helping people. So I wanted to help educate, especially people of color, and really help them understand money and finances. And I was considering getting into more of a finance type. So I always knew I wanted to get into like finance, accounting type role, and I was considering getting into finance. But then when I really started looking at it, I was just like, you know what? Let me get into accounting, because if I understand accounting, then I can understand finance, and I can understand economics, and I can understand pretty much taxes and everything else that surrounds business. So I wanted to pretty much be someone who just really understood business really well. So yeah.
Let me ask you this: as a business owner, when does it make sense to transfer somebody to a full-time employee compared to just paying them as a contractor, like 1099 work? So when does that make sense?
Yeah, so there's a lot of rules on that. So basically, you have a contractor that you could have, and you have a W-2 worker. So basically, the distinction is, from a tax perspective, it's more beneficial to pay someone as a contractor because you don't have to take care of their taxes. Taxes are on them, and that's like a 1099. But the way that someone could be considered a 1099 is there's certain rules and requirements. One of the things is basically you can't have control over them. So let's say you were to hire me, work with me, you can't tell me like you need to come to my office from 8 to 9 or 8 to 6 or whatever. I'm pretty much working on my own schedule. So they look at pretty much it's based on the business relationship. How much control do you have over them? Do they have to work a certain amount of hours, etc.? So if you could keep someone as a contractor, it's beneficial for you. If you want to go ahead and move someone to a full-time employee, which is someone who you have working on a set schedule, and they pretty much they may or may not have to come physically to a location and stuff like that, that's when you have to have them as a W-2 worker, and that's when you put them on payroll, and then you take care of that about 7.5 of their payroll taxes for them, and they pay the other part of it.
Okay, so as a business owner, I'm paying 7.5 because the payroll tax, you said, I think it's 15.
15 combined.
15 combined. So I, as a business owner, would pay 7.5, and the employee would pay 7.5. So for each and every employee, I would have to pay 7.5%.
Yeah, that's why I'm saying, like, if you could try to keep contractors, it's good. But obviously, it comes to a certain point where, depending on how your business is structured, you may need people like, you may need that control. You need that control.
Yeah, I'm asking because I'm thinking about actually hiring somebody full time, to do my audio and video editing and stuff like that, and I need that because I'm gonna be producing a lot of content.
Yeah,
I really want the control and that exclusivity. Like, hey, you work for me. Like, you produce all of this. You can do some side work or whatever, but 30 or 40 of your hours are dedicated to my company because I have consistent work. And I'm trying to figure out if, I should actually do the employee or just do a long form contract and say, hey, you're dedicated to me to work 20 hours a week, but it's flexible. So you come in and you work at your time. So I'm trying to really figure that out.
Yeah, I think in that situation, you can get away with doing the contractor work, but again, it's just based on that business relationship. So then I can send you, and I can pretty much give you a breakdown of what that looks like, but it's going to be really based on that business relationship.
So if you are a business owner, and let's say you have 50 employees, and you want to offer retirement accounts to your top managers, you want to match their contributions. What benefits does that business owner get for offering retirement accounts and offering matches and things of that nature? What tax benefits are there for the business owner, not necessarily just the employee?
Yeah, so you have basically what are called fringe benefits. So those could potentially be considered fringe benefits. So one of the things, it doesn't help you so much as a business owner with doing the retirement accounts, but you have things like maybe paying for, like one of the things that they just instituted right now for employers to help out their employees is pretty much giving them like stipends for pretty much like, because not everyone has to work from home, right? So one of the things that they did was, I think it's called Section 139, where it's a disaster payment plan. Basically, let's say you pay for an employee's working from home expenses, so maybe they had to buy like a computer, they had to buy a mouse, they had to do all this stuff because now they're working remotely. So those are kind of things that you can do. They used to also doing things like, I believe, cafeteria, so paying for their meals is one of the things that you can do, or paying for like, well, I think they may have gotten rid of the cafeteria, but like paying for small amenities can help you save some money as a business owner. So those kind of fringe benefits.
Okay, I got one more question about the employee, or just as a business owner. So, okay, let's say a business owner makes $100,000 and they're consulting with their CPA tax attorney, and they say, okay, you're gonna have to pay taxes on this $100,000, and they did not pay themselves a salary throughout the year. How does that work? Can they just write themselves a $50,000 check and say, this is my salary, and then pay taxes on the $50,000, or does it have to be consistent throughout the year to make sense to the government?
Yeah, so the best practice is to pay it out quarterly, and you can give the government a quarterly report and paying out the taxes during the year. In that scenario, so if you need to, then yeah, you can pretty much just, right at the end of the year, just boom, just go ahead and take care of the check.
Okay, man, that's all. That was kind of a personal question. That's kind of a personal question. Like, yeah, so it's my first time, so I'm like, okay, let's just write a check, or like, what do I do?
Yeah,
so.
and that's one of the, and going back to it, so with the S corp, that's one of the requirements is you do have to pay yourself a salary. So if you don't pay yourself a salary during the year, they're gonna look at it as like, well, we're not gonna give you the benefit of having the S corp, and go ahead and tax you the way they want to tax you. So yeah, you want to, if you're in that position, yeah, you can ultimately just go ahead and just take care of it really quickly at the end of the year, but that's not the best practice. You want to do it, consistently throughout the year and pay it out. So yeah.
All right, man. So thank you. So we got CPA, best-selling author, wealth strategist, coach, everything, man. So you taught me a lot just throughout this conversation. So I'm sure our audience got a lot of value from it. I thank you for your time. I know you're a busy guy running your tax firm. So give people a call to action. How can they check out your book, or get in contact with you on social media?
Absolutely, yeah. So to get in contact with me, I'm Michel Valbrun, pretty much on all platforms. That's spelled MichelValbrun. So you can find me on all platforms. There's also a program that I actually released as well. So I just released a program going over a lot of these different tax strategies and ways you could save taxes, so that you can find that on taxwealthsecrets.com. So it's Tax Wealth Secrets, just as it sounds. And then we also have a 50% coupon on that as well. So if you go into my link tree, or go on taxwealthsecrets.com, then you can go ahead and put in the coupon code and save 50% on that.
Is that a course or ebook or something?
That's a course.
Okay.
Yep. So that's a course.
All right. Thank you.
From a young age, I just always knew I wanted to be a business owner, bro.
Right.
Before I even knew what that meant, it just felt like, hey, I should be doing something independent. I should be creating something of my own, being my own boss, being in control.
Right.